None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. Well, here we are at the end of a week, of a shortened week. We've had quite a week. I want to welcome you all to our Market Thunder broadcast. We're hopefully going to get better at this as it goes. Today it's just going to be me on, and we're going to be talking about the general trends that was going on in the market this week, some of the political risk that still is out there, the VPM database. We're going to talk treasuries, dollar, and we're going to do a stock of the day, which will be McDonald's today. It's one of our more widely held stocks that we have. Anyway, just again, some cleanup stuff. Make sure if the video stops working or moving, just refresh your screen. Should bring you back in case there's any kind of technical glitches. We've seen that out in the field a little bit, and it's pretty common actually on one of these streaming broadcasts. Anyway, let's go ahead and start looking at some of the market action here. And as usual, I'm going to start with the 1 minute chart. We're looking at the chart that is the intraday futures chart. It's a 1 minute graph that we're seeing here. We're trading about 2 handles off of the high right now. Let me go. I want to get more of the chart over here so we can just look at the chart here. The volatility has been pretty quiet so far today. We've seen a little downside, a little bit of upside. It's really been pretty stable for the most part. And we start to look at some of the shorter term cycles, and we'll start to look at this next set of graphs here, which is this is basically the futures again, and we're looking at a 5 minute chart on the right hand side and an hourly chart on the left hand side of it. And we're probably another several hours away from a major cycle. We had, let me go to full screen on this here so you can see what I'm talking about, and we'll bring up the whiteboard a little bit so we can point out some things. You can see this is a moving average envelope, and they're exponential moving averages that are on this page. I want to show you something. This is something I've watched for probably about 3 years now. And some of my shorter term trading, I utilize this stuff. Let me bring up the whiteboard so that we can see exactly what I'm talking about here. I'm going to draw arrows over these areas where I want to reference, and this is interesting. This is basically a 24-hour chart. This chart never stops trading. The market doesn't close. So futures, it's going around the clock. But there seems to be a cycle. It runs about 23 to 21 hours, and the cycle that you see in the bottom, I believe, is a 23 cycle hour right now. Say we came in a little late yesterday. Right now we came early in on this cycle today. But these spikes, what they represent is volume spikes relative to price movement, and it's a rate of change of the volume. So rather than just looking at pure volume, we're looking at the rate of change of volume. So to see what type of action is coming in. A lot of times these spikes will come, and these clusters where these arrows are will come around where the market is trying to put even a top or bottom in. And you can see we had a few bars that were it's pretty quiet today, really, and it's probably because it's pre-holiday markets that are coming into play, and we're not going to see that much action today. We'll see how the probably last hour and a half, 2 hours play out today will really be what this day ends up to be. But these cycles are pretty regular. They tend to happen at turning points. These are things I'm watching a lot of times in commentary. I'll reference, if certain things don't happen within a 3-hour period or something, that will tell us that there's a more significant turning point happening, or if it penetrates something, it will signal a breakout. But this market, what we've seen here, I'm just going to draw a line through here. We're a little bit positive where we've been, but for the last couple of days, we've really been range bound, and we've seen a couple really good days. And what I want to talk about today, when it comes from just talking about what's happened this week, is really talk about the retest of last Friday's low and how the market acted, and specifically on Monday and Tuesday, which were the most significant days of the week from my standpoint. Let's go ahead and let's take a look at a couple of these charts that I'm talking about here. We'll start off with looking at the daily. This is the cash index now. This is the daily index, and what we're seeing here is momentum is actually not accelerating here. You can see I just have the 1 ppm 1 here, and it's not accelerating. It's pretty flat, actually. It's at 0.10. You need a value greater than 0.25 to really generate any kind of real momentum as far as the market being able to hold that average. So this is ppm 1, the 10-period moving average. Let me just bring up the whiteboard so we can point out a couple of things so you can fully understand what's going on here. See a couple things here. See, I just put an arrow in here, and it's coming into this range. It looks to me that this 10-period moving average is becoming vulnerable. And what's happening, I'll bring up another graphic that will help us to understand a little bit more. But there's a couple things going on here. These are hard to see. Matter of fact, I'm going to point them out, then I'll blow them up in a minute. You see a lot of little fine lines on this chart. This is what I call the VPM webs, and what they do is they're linear regressions, and we're starting to get something which I refer to as a veil, which tells you that there's major resistance coming. In the commentary last night, I talked about how the market's traded into major resistance. Well, we're there. There's not a lot of possibilities here, and we are looking at the hourly chart right now, and I referenced that we were looking at daily. So let me go up here, and let's go up to one more level here and take a look at what the daily is looking like as well. And the daily we've actually got, and that was on a short-term basis. Now we'll look at the daily, and the daily has a pretty interesting pattern, and I'm going to draw this out because I believe this is what's going on. I know it feels like since the market rebounded sharply off the lows that something big was happening. Really all we saw was a reactionary rebound. So here what we're going to see is that the market, I'm just going to draw this pattern, these stair steps down. From an Elliott standpoint, this is probably an ABC down, and what we're seeing now is a potential another ABC pattern. And what we don't know is whether the highs that we put in yesterday, and see, we did make a slightly higher high today at 1865.03, so that's a new high since the rebound started. So it looks to me, based on hourly chart and looking at the daily chart, that we're going to most likely start to fall back. I'm going to take those arrows off. So what it ends up being is this ends up to be there ends up to be a B wave and then a C wave. And what we don't know is that 1814 level that we printed last Friday, whether that level holds or not. based on a number of things, I think there is evidence that there's a good chance for it to retest and to break through. I've talked a lot about this number, 1795. That's a very significant number in the pattern. If that's broken, then we're likely to see a move down pretty substantially from there. And I believe that, and I'm going to talk about what happened on the database on Monday and some of the configuration that's going on there as well. But from the standpoint of this trend, this is what's out. We don't know exactly what's going to happen. I'm going to take a couple bars off here. And this pattern, this last pattern is unfolding. If it comes down and retests again and then rebounds and does not make a new high above this level here where I just drawn the arrow, this is going to be your band or your trading band that we're going to be stuck in. And this is going to take potentially through next week and into the following week to actually form. And the only thing that would, if it violates the highs that we've seen today, the 1865, then we could see it expand out. The high that we had a couple, let's see, I think it was about 5 days ago, was 1872, I think, '05. And when I'm in a whiteboard mode, I can't bring up the numbers. But the bottom line is that could be extended, but it's probably not going to be. We're probably seeing the high of this particular sequence, and we're going to see some backfilling here, and we're going to find out more about the character of this pattern over the next, let's call it 5 to 8 sessions. And depending on how that comes out, will tell us something pretty good. What it's setting up for right now is the potential for the next leg down to come down where I've drawn this line just now, and that the target would be around the 1775 level on the downside. Let's switch over to the intermediate charts now and just talk a little bit about what's going on there as far as the same patterns that we're just looking at here. A couple things you'll see. I want to point out, if you recall, the orange chart at the bottom is the VIX index. The center is once again the PPM1, so it's telling us a little bit about the shorter term standpoint from the weekly charts. But this pattern has become very, very sloppy. And I do want to make a note here because several of you have asked. I believe I have 1.2 models on this chart right now. That may not be the optimized in the VPM. I should probably look that up, and maybe Mitch, if you want to look it up for me, I know you're watching, just go ahead and maybe Skype that to me so I can see what that is. I can change the model over. But bottom line is, it's not so much important about what the model is right now, it's the pattern in itself, what's going on here. And what we're seeing is complete sideways movement. Let's go to the whiteboard again. There's a center line pretty much that is running on this market, and it's probably around the 1855, 1860 level is the midpoint, and the market's just waffling above and below this line. The orange line down below, like I said, down here is the VIX index. It's actually collapsed all the way back down to 1365, going just from last Friday. We were printing up at the close to 16 something at that point in time, and now we've completely reversed the VIX. Everything's better from a volatility, or at least a risk standpoint. The market participants are looking at that there's not that much risk at the moment, and this flat line tells you that that's how the market's trading. So we're not really seeing any kind of leading expectation or anything there. The bias on the indicator that I have here, I'll go ahead and point this out. You can see a slight uptick. It's trying to break through the line. We are right now at 0.35, and I mentioned earlier you have to be at a 0.25 to be in an uptrend, and that current value of this 10-period moving average is see here, it's 1859 or so. So we're just trading right at it. So we're maintaining that value as it goes through. So from a intermediate trend standpoint, we're really neutral here. We've signaled that there's an intermediate type at this time. There's an intermediate top at this time, and what we're doing now is just seeing a consolidation and trying to figure out what the next major movement in this market is. Right now it's neutral. We're looking at the daily is neutral, and let's go and look at the monthly chart here real quick. Just get a little longer term perspective. I'm going to bring this chart in just a little bit so you can see more of it. And this takes us all the way back in this view, all the way back to 1995, what you're seeing on this chart. And you'll notice something pretty interesting. Once again, I still have the VPM webs up, and there is when the linear regressions become very tight, I've nicknamed this the rope, and I have a saying around the rope: never sell a rope, because it's not going to collapse. It'll trade around it, but it won't go down. You can see we had, bringing up the whiteboard here, you can see we had, there's a period, I'm going to draw the periods where these ropes existed, and this is the longest period I've seen in this type of market. And you'll see, going back in 2000, we had a pretty good one breaking off the highs, and we had a minor one that broke down below right here, and then there was another rope here. And when those things are happening, the market's in a very robust trend. It has a very low probability of actually breaking through or making an abrupt change. What will happen next is we'll get either a veil, or we'll get some kind of broadening pattern, just like what we've seen at these other tops here, just drawing those in. You'll start to get some sort, when there's a switch in the market coming, you'll start to see different elements start to come into this. So from a long-term standpoint, we're still in a I would call it a pretty robust uptrend, but within the contents of that, we can trade down a fair ways. We can trade down to 1775, and if that level breaks, we could go as low as 1645. I referenced that in our outlook for this year. Those are still levels that are out there. Even though the market's managed to make new historical highs in this first quarter, we still are possible. I guess the possibilities are still there. The probabilities are still there for a decline. Okay, let's from here we're going to go back to the daily. Or go back to the weekly graph, and you can see the same patterns are unfolding in this chart. You find the chart I'm looking for here. I want to go up with the same charts, and I want to do a quick analysis of what's going on with the PPMs here. And this is 60 minutes, so let's go to the daily. So we want to see all three trend levels here. And I think this is important. I'm going to format something here. I can see that is currently on, so I want to take that off real quick. So we can see this pattern that is unfolding here, and once again it's very flat. I can draw a straight line through here. We're right at the pivot point of these levels, and whether it's going to be important. We could see some movement today. I mean, we're looking at a completely flat market. My bet is that maybe there's some squaring of the books, and that would be it. So Mitch has informed me that 1.2 is the right model for Optimize, so we do have the right model on this. So when we're using the 1.2 on the index anyway. So as we look at this pattern, it continues to unfold. Like I said, all three of these indexes from the PPM's viewpoint are completely flat. So flipping a coin at this time is, from a PPM standpoint, from a trend standpoint, is about the best you're going to come up with. But when you start looking at the patterns, I go back to the pattern that I was talking about earlier. We have an ABC down. There's a couple things that can happen here. If we get into some elongated pattern that goes all the way through, let's say we come into May and June, and who knows, maybe we get the summertime blues going, and we've got all the way through the summer, we've just got this sideways pattern. It's really going to come down to, I think, more of the fundamentals that continue to evolve in the economy. You know, we're seeing, I believe, jobless claims today was down to the pre-crisis levels. I think it was around 304,000. So that's pretty typical now. So certainly there's been a normalization in some of the labor market. It really comes down to some more of the retail sales growth and some other things that are going to keep things going. But in the end, those fundamentals are pretty much what the market was telling us was going to happen 6 months ago when we were rallying. So the next movement in the market is going to tell us about what's likely to happen in the economy. You listen, if you turn on the talking heads at all, you'll hear once again almost everybody, because Janet Yellen was somewhat, I guess, continues to be dovish. She continues to be dovish, and everybody is buying into that everything's going to be fine, and the Federal Reserve is going to continue to keep things going to those levels. So what I want to point out is a couple things here as we look through these trends. Is the trends are actually neutral right now, and I'm going to bring in, and we'll bring up VPM in a database here in a few minutes. But really what's happening on a trend basis, and it's why you see some of the movements in the VPM database, we're at 47% bullish right now, and that tells me this is basically a neutral. It's got a slight bias to the upside. When we do the technicals, we confirm that. I like to do something I call reversed fundamentals. So I look at the technical outlook, say here's what it looks like it should be doing. What is there anything out there that could tell me that those things could happen? So if I have a highly positive outlook, then I would look to say, okay, here's what it says. Let's go look at fundamentals, and are they growing to that way? Are they telling us what's going on? And right now we've got just a completely flat neutral outlook. So there's no way to make any short-term predictions from what's going to happen here, because there's just nothing there other than the sideways movement. When you go to the patterns, there's more of a bias on a short-term basis to the downside to see if we can test that 1795 level. If that is broken, then the old numbers I've talked about several times of 1905, 1919, those from a longer-term standpoint are still valid. There's even a 19, basically we'll call it 70, and the number is actually 1969, but those things are still out there, and they're still absolutely valid from a longer term standpoint. On a shorter term basis, we're just not going to see that movement that nothing's going to happen today. So when we start to look at the VPM database and what's going on, well, with it pulling back to 47% this week, I've seen a lot of strategies like maybe Global Equity 4 in our premiers and things of that sort. We pulled back to a 50-50 exposure. So what is the goal of VPM? To adjust the risk in different elements of time. So in this moment of uncertainty, there's no trends. VPM is a trend following system. It's going to flatten out other than the things that are still showing trending characteristics. So that's what's happened in this last week. It doesn't mean the end of the world's coming. It doesn't mean anything other than there is risk in the market. And in fact, if you look at how a lot of the strategies, something like index-based, like a Global Equity 4, how it acted between 2000, let's call it 2011, and before, let's say, third quarter of 2013, what we saw there was VPM had more cash than usual, and it was playing protect. And during that time, there was a lot of volatility. There were trends. The market indices managed to eke out positive years during that period of time, But the example is 2011 had about a 31% decline in the middle from peak to valley, and it ended up 11 started and finished almost exactly at the same point. So what that does is continues to cause some things to go on from the standpoint of just this non-trending. It gets us into a very protective phase, and that's from I guess the best way to look at it. What I'm saying right now is our database, the technicals, everything is doing exactly what it's supposed to do. So anxiety of having too much cash because the market bounced off in a low of last week or any of those things would be inappropriate just from the standpoint of what's really going on. And even if the market were to somehow eke out a new high, I can't imagine there'd be a lot of buyers there. There's still a lot of folks looking to square books. We just came into the second quarter. We're still working the beginnings of how this is going to play out. We've got earnings coming on. There's nothing that exciting from the earnings standpoint. It's almost like they're in the background right now, even though they're happening pretty substantial. So let's go over and let's take a look at VPM now. And let's talk about the database. Oh, nice. Okay. 1 second here while I deal with this. So what we're doing here and looking at the database, and I continue to talk about this thing I call the death pattern, and it continues to unfold just like it has before. And I think this is important to understand from I guess from an intermediate to longer term basis. I still feel that we're putting in a major top here. Whether or not we get some kind of decline that's 20-30% like we've seen in 2008 or not, this is the similar pattern that's unfolded, and this is why we're seeing what's happening internally with VPM in the database is that it's actually going into a protective mode just because a lot of stocks their trends are ending. So the philosophy behind my philosophy and what I programmed into the software, it's important to understand is that I feel like I'd rather be in cash than be taking risk when it's uncertain that there's not a trend there. And if that's the case, then like I said, I'd rather be in cash. I'd rather be having a pina colada on the beach than having risk and worrying about it at night. So what the software has done is actually pulled that risk way back. And you can see this downsloping trends over here. And go ahead and bring the whiteboard up. I know I've discussed this. Maybe I think it's important, so I'm going to keep hammering on this thing because it's easy to forget that it's out there. But this is the trend that I'm drawing here on the page, and you're seeing from a standpoint where the peak was way back in 2013. It's interesting that it peaked out before this last run occurred. And now what we've seen is continuing downward highs on the pattern. So you're seeing stair-stepping on the downside. And what it ends up doing is just really showing you that the participation of the number of stocks or number of instruments participating in this rally is getting narrower and narrower. And that ultimately results in a more of a I guess climactic standpoint from the trend. And if you look at the trends, we were talking about how the webs look right now and the monthly, these things are getting very, very elongated. In fact, they're becoming historical. And the nice thing about the markets, they're never the same. There's always a new historical event that's going to happen, and we are witnessing one of those right now. So let's look at one more thing here. Let's go to research in 2.0. I'm going to go to the All Stats page, and I'm not sure you folks look at this page enough, actually, but let me toggle down a little bit so we can see this. In fact, I think I'm going to make it a touch bigger. So in this section here, I've got the positions overview. I've talked about this before, but what's happening here from a database standpoint, because of the selling that we saw last week, we've seen a somewhat of a shortening of the average duration, although it still remains at about 50%. So what that means is the items that we own right now, the symbols that we own right now, are 50% of their expected holding period has expired. But when you look at the profit down here, the projected profit, it's only 20.3%, and that has a lot to do with the items that a lot of things that we sold on Monday were things that had substantial profits, and for the most part it was profit taking that we did from the VPM database standpoint, and about probably 65% of all the trades we sold had profits in them, and we were taking, not only were they profits, most of them were long-term profits at that, so there's some pretty good tax efficiency as well. But when we start looking at this thing, we're seeing the average optimized 196 trading days. We're currently only about 82 of what we're currently holding. There are things that are still longer in the tooth, but this is the average number. So this is reflecting on each model what they are. And very seldom do we get much over about 74 or 75% on this database. Let's go back to a normal view on this. So from a standpoint of what's going on in VPM, going back to the home page here real quick and bringing up this chart on the overall view of the database, what we're seeing here is really just a continuation of what always happens in every market cycle. And I guess after watching, I've had this database up in my life since 1998. So getting a lot of years of watching a database. I was never able to see all of the ideas and things that I have generated over my career and understanding that in such a form like this. And I've spent, like I said, the last 15, 16 years now studying this thing and understanding the movements. And some of the things that we're going to be talking to you folks about next week, we exposed a little bit. If you go on our dashboard, we're working on getting a little better layout for you so that you can go through some of the in-depth, we'll call it the VPM depth charts that we have on sectors, and you can start to see a little better part of the rotation, where the market's moving, what's working, what's changing in the database. So that's going to be, those are things that we've been working on internally that we're finally bringing out to you, and we're gonna be doing some a show on that just to show you exactly how that works. Going back over to TradeStation now, and we're gonna go and we're gonna cover. Before I do this, I want to go in because I think this is important to understand here. I'll come back live with you here for a few minutes. Let's talk about some of the geopolitical risk that's out there. Pretty much the same thing that's been out there is the Ukraine situation with Putin pounding on his chest and showing the Western world that he's pretty much going to do what he wants to do. That risk, it's almost impossible to try to bring that in and say, here's what the risk is. It's really volatile. It depends on what happens from obvious. I'm quoting the obvious, I guess. If they make some sort of invasion and all, then there might be something that goes on, and maybe there's some more political risk there. I actually thought about this. I think Putin's actually protecting his border more so getting ready to invade the Ukraine, because all these folks, you have to realize, I think this is a subject that people have not talked about when it comes to Ukraine. The Ukraine government is so corrupt. They have spent every dollar. They're bankrupt. The only reason why they're running the government at all today is because the IMF and the U.S. has given them money, and the people there are sick of it. There's a lot of folks that, because of the former Soviet bloc, that are very pro-Russian, and now they're just tired of it, and they want something new. The government in Ukraine has very little to offer. You probably heard that when they started to roll in tanks into some of the eastern cities, that some of the troops were defecting and actually flying Russian flags on Ukrainian tanks. So, that situation is volatile. I don't know that it's as scary as some folks would point it out. I've seen people, waving flags of World War III. No one knows about those things. But from the standpoint of the markets right now, it seems to be way, way in the background. It could emerge if there was some sort of conflict. The U.S. is posturing, telling Putin, stop it, but he's not listening. And the Western world has no power over him at all. And I think that the interesting thing is I saw he's given basically Ukraine owes Russia $2.2 billion in some energy, and he's talking about cutting the gas off, and it could affect the European customers that it flows through. And it's somewhat interesting from the standpoint that those things are happening. So anyway, I just wanted to mention that. I don't think there's anything else out there that is going to, really bring any other risks that we don't know about. But that's I guess that's the problem with geopolitical risk. It shows up out of nowhere. So what I'm going to do next is we're going to go through treasuries, the dollar. We'll do the stock of the day, and then we'll start to get pretty close to the end of the show then. So let's go back over to analysis. And let's do just that. We've got a couple things here that I think are going to be somewhat reviewing. I continue to point out that in the outlook, first two quarters are looking for rates to decline. That is still happening. Let's go ahead and bring up the 10-year. Ten-year continues to trade just below the 270 level. It seems to be stuck here. Interesting enough, I saw some comments that some of you tweeted us, and I'll try to cover some of those things here today. Is if the treasuries continue to decline, is that going to be positive for the stock market? And I don't think that there's a link at the moment that's that sensitive. Looking at this chart, we're seeing a stabilization. It almost looks like the indexes themselves from the stock indexes, that the interest rates are very, very stable here. And we're looking at the weekly graph. If we go over and look at, let's change it over and do a shorter term view, you'll see even a more detail, more of the noise that we've been seeing in the marketplace from the standpoint of really of it just staying within this range right here. Here's the 270 level. I just drew the line across. We're come back up to it. We're a little bit below it, but we're just waffling. We're locked in a range 285, probably 260 on the downside, and that appears to be, I think, in context with what the Federal Reserve would like to see. It is I guess there's still QE going on as we speak, even though it's gradually cutting back, but it is still out there, and this has stabilized these rates and continue to see rates stabilize here. They are starting to move up on a short-term basis. When we go back to the intermediate charts, we go back to weekly, you're going to see that it's rebounding. All three, this is actually important, and I've talked about this several times. At what point does a trend change or accelerate? And I think this is probably a good topic to talk about here briefly. one of the things I've talked about before, we've talked about how moving averages, these three moving averages, I use 10, 21, and 40 period moving averages, and how each, during trending modes, they spread out. So we've seen the same thing here. When the market was going up, it spreads, they contract, and now what we've got is what I call a complete convergence here. So this area where I just drew the circle on, all three averages have converged at this point. And if you look at the slope of the PPMs down here below, they're neutral, but they're actually turning up. So what that tells us is that there is a slight leaning at this time toward the probability starting to suggest that interest rates are going to go up. I'll put up a couple of calculations here in a minute and talk about what those probabilities are, but they're not as they've been moderated since I did the outlook because of some of this sideways events and the way that the patterns are unfolded. So when you're doing forward-looking analysis, you're always trying to anticipate certain events if they happen, what that means. But when you get there, it really comes to what type of patterns and what type of structure. So some people look at purely price levels of what's going on in the market. And from my viewpoint, I don't spend a lot of time counting every intricate wave from an Elliott wave standpoint, but what I do look at is the structure. So the structure of this market is corrective in nature, meaning that it moved up, it is now going into, let me just clear this out, I'll bring up some arrows here to show you what I'm talking about here. It moved up here, and now what we're getting is a pattern like this. And this last pattern that I've drawn down, this arrow that I've got here, this is potentially what's called an ABCDE corrective wave. And it's also potentially a wave 4, and it's complex in nature. So I don't want to get too technical on what's happening, but let's just look at this previous wave. We got a high, we lit a 1, 2, 3 here, and then we went up. This is much more complex, which is typical. There's a thing called the rule of alternation in Elliott wave. And what it tells you is that if the first sequence was an ABC, the next one's going to be ABCDE, or it's going to be what they call a double 3, which is an ABC X ABC. You never know what that formation is going to be, but this is the formation that's unfolding. And what it tells you then, if that's the analysis from the structural standpoint, that the next move will be up. And the question is how much. And there's even some answers there from looking at it from an Elliott perspective, as well as just looking at some of the potential Fibonacci projections that are coming out of this pattern. So I'm going to go up here and bring up some calculations here. So, and there's two things I'm going to look at here. We're going to look at the very short-term calculations, which right now suggests that the market is, the targets on the upside are 283 to 298. So back to 3% is pretty much a resistance wall on the intermediate. So falls in line with the 285, 260 level that we're talking about. When we go to the next level, though, and we go up to the monthly chart, now we start to see that just in last month, this new calculation came up, and it's still valid right now. This is telling us that the target range is 314 to the 350 range on the upside. And that actually coincides, if I go back to the weekly charts just for a second here, jumping back and forth, this first move that we saw here was about this leg here went from 160 about 220, went about 60, around 60, 65 basis points. And what that tells us is this whole thing I was talking about a minute ago, the wave 2 simple and the wave 4, well, the other characteristic is that wave 1 and 5 tend to be similar in length, and it was around 65 basis points. If you had 65 basis points from where we've been, you get into the 320, 340 range as far as a projection from that pattern becoming more realistic and walking forward the theory and the structure. And then we look at the PPMs, we look at all this stuff. It's pretty easily, I think, to say that we will see higher rates as we go on. There were some other questions about this higher rate scenario. Is what does that really mean? What does that mean for gold? What does that mean for the market in itself? And I think that I was quoted, and certainly in commentary and even in the outlook that I did, is that the higher rates, this is more of a normalization situation. It's not really something that's going to cause any real structural issues at this time. If we were to get into above 4%, 440 on the 10-year, then we've got issues. We've got issues with refinancing of debt. I mentioned in the outlook that there's a huge amount of corporate debt that needs to be rolled over. If you think going back to the last 5 years, looking back, there was a massive amount of corporate debt that was borrowed at a very low rate because of the zero rate policy. Those rates have changed now somewhat in structure. You had a 10-year Treasury at 160, which is now 260. But over around 440 is where there's a real tipping point from potential damaging of earnings and other aspects of the markets as they go forward. So for now, it's pretty stable. It shouldn't be a lot of effect on earnings, even if we went to the 320 level or anything like that. It's not going to be much there. So moving along here, we got about 15 minutes left in the show. But that's a pretty good, and I think, outlook for what's happening with treasuries right now. As far as a tipping point as when is that going to happen, we're probably going to have to see the market move over that 285 level, 280, 285 on a weekly closing basis. And we would probably then begin to see further advancing from the interest rate standpoint. Let's take a look at let's go to the dollar now. The dollar's been under a little pressure here. It's our weekly, but once again, it's somewhat looks like treasuries, so it makes sense, right? Higher rates, dollar should be firmer. And that's a pretty, I think, standard view of the world that's going to happen. But we have seen some recent weakness. Let's go to more of a short-term viewpoint of this and look at the daily graphs on this. You can see slight bias to downside, but in the last couple of days we've seen some firming. In spite of what Janet Yellen said the other day, there was some weakness coming in the dollar initially. It's actually firmed up since then. And we're continuing to see the same patterns that we've seen over and over that we talked about. So all of these markets are related. We know that. And they all seem to be telling a story. And it looks to me that treasuries would move up. There might be a slight bias to the downside on the market. And that would be pretty, I would think would be a pretty classical view of how things will unfold. Because if you look at the patterns that we were talking about earlier on the stock market, there is a slight bias to the downside, even though the longer term is still bullish. That can change. 1795, a close under that on a monthly basis changes that whole outlook. We start to negate those patterns. We start to really set up some more potential risk in the equity markets. And there will also be a fair amount of risk in the treasury markets. But if you look at what VPM has done from a standpoint of the treasury markets and the interest rates in general, what you're seeing is we've actually added, especially in the muni area, you can see this through looking at the transparency on the fund section in our new VPM viewpoint that we have on the dashboard. You can see there's been an increase, and rightfully so. We've got a decent bid that we've been attracted to and participating in from the treasury from interest rate standpoint. So these lower rates are still continuing on. We're looking now at, on a regular bias, we're probably into about 3, working on 4 months of a trend. Typically, a lot of the patterns that VPM will play into will be anywhere from 6 to 8 months, maybe 9. So these patterns can elongate. We're trying to do our best to anticipate them, but it's pretty hard to make a hard call and say, hey, next July, this is it. What everything I've done in my life, in my work, is responding to the changes, understanding the structure, and understand that sometimes the markets can actually continue on by just going through their normal ebbs and flows. All of a sudden the patterns unfold and they're bigger. Somebody will go, hey Bob, I thought you were really bearish a little while ago. Well, I was. The patterns changed, and the job is, from the VPM software, from my viewpoint, from an analyst, is to look at the market. I'm analyzing the market. I'm not predicting or trying to tell it where to go. We see the perma bears, people like Harry Dent, who has been bearish for 9 years now, still bearish as the market makes historical highs and tries to. They're hype artists that try to get. There are people that want to believe that stuff. What I do, what the software does, is really responding to changes as they occur and making analytics about them and trying to carry forward and walk forward those situations. So let's go back and let's do our stock of the day. And the stock of the day today is going to be McDonald's. And Mitchell, and you hear this, if you could tell me if I believe this is, let me look and see what model I have on here. I think it's 1.2. Let's take a look. I do have 1.2 on here. So we'll make sure we have the right model, but we'll go ahead and look at the technical aspect of McDonald's. It's been a pretty good stock. It's done quite well. And you know what? I can do that, can't I? I'll go over here to VPM real quick. Let's just put MCD and find out. Good news, 1.2. So we'll go back to TradeStation, and this is the right analysis for this particular chart. A couple things I want to point out here, and we're seeing, this is really what I do and how I view the world, and what the software does that I program VPM, and is really making analysis of. This is a classic view here. Let's take a look at and point out a couple of things here that I think will help you understand what I'm talking about here. This was an interesting period here. There was a trade signal right here where we bought and sold in this thing. So we literally bought it right after the breakout into this pattern. Market goes sideways, dips back down, maybe is about unchanged and maybe a little negative, get another surge in the market, and then ultimately it falls back and we sell out of it. And so it's a pretty choppy pattern. So now the market goes sideways, and I'm going to erase this. So right here was our exit point. Market consolidates. It does not go down. There was a potential for it to go down during this period of time. It does not. Market consolidates again. We get another buy signal here, and now we're participating in this trend. As I've talked about many times before, what's happening with the moving averages? They're spreading out. And I will, I'm going to come live. I'm going to tell you a little story that happened years ago when I was on a trading pit. A good friend of mine, we were in different pits, and he would do a signal with like this, with the three fingers spread out. And what that would mean is that, are we in an uptrend? I've talked to him about how these things happen, and if it was a downtrend, he would point it down. He didn't want to trade three. He wanted to know to me, is this a trend? Are we in a downtrend or uptrend? And it all had to do with being able to understand what is going on with the trend. So this is the daily on this, and there's a pretty good trend on the daily. So let's go ahead and take a look at how this plays out on the next level. And on the next level, you'll see this pattern is even bigger and more sustainable, I think. Although we're hitting a couple things here. I'm going to blow this chart up real quick. Just going to blow up this last section that we're looking at here, so you can see some of the detail. Notice that the price targets here, we've hit the price targets, and they are currently high price target 101. We're currently trading 101.12. So we're trading right at the price targets that were generated out of the pattern. Does not mean that this pattern is over. We also look, and we purchased this thing way back on, see here, purchased it way back in December, so we're continuing to hold this position here. And it looks to me, if we go back and zoom out a little bit, if we start to look at what McDonald's has done, we're looking at the 104 level, which was the old highs back in April of last year. And whether it can get back to that or not, I don't know, but there's a decent profit if we continue to run up toward the 104, 105 level. This is probably where we'll see some resistance. Maybe we'll get a new calculation for this. But for now, this trend is very much alive. We have a 0.40 and a 0.11 on the intermediate, but the short-term 0.40 is strong enough to maintain this pattern. And the 10-period moving average right now is 97.09, and it's moving up approximately about 50 cents per week. So every week that goes by, that support line is moving up, and the PPM is telling us that the probabilities of this thing declining below that is pretty low. So this looks pretty good from the standpoint of what's going on. So let's go ahead and take a look at the long-term monthly here. And you can see this, I know this is a little narrow to I'm going to turn something off here real quick, just so I want to get rid of a couple elements here. It'll make the chart a little easier to read. And what we're looking at now is more of a, without all the indicators on here, it's in a neutral mode on a long-term basis, but it's starting to accelerate out of this pattern. And once again, if you notice this elongated pattern over to the left here, go ahead and draw an arrow here. This pattern right here, and then you see a similar pattern here. They have been resolving themselves to the upside. And stocks aren't perpetual machines for sure, but there appears to be some bias to the upside. Indicators are positive or turning up. This is all on a very long-term basis. So each one of the bars you're looking at is a month. And it looks like if we can get over 104, 105, then the possibilities don't have any current projections from the indicator standpoint, from the Fibonacci indicators, but it would suggest that we would probably be able to run, my guess would be up to 110, 112, and that would be a pretty substantial trade from that standpoint. So in the final moments of the week that we have going here, I think we hopefully covered things for you enough that you have a good understanding of what's going on in the markets. I think from an overall viewpoint, it looks like everything's going to be stable to a point for the next week, 8-10 days, and I don't really see a lot of disruption. Now, there could be a surprise. We talked about the Ukrainian situation. Could there be news out of there? Yes. As far as economics, as far as letting economic flow happen, there's not going to be too much that you're going to have to deal with that's going to be substantial at this time, middle month. It's going to be more about earnings. Maybe there's a couple surprises or positives or negatives that might affect market sentiment to a point. But it looks like we're going to continue to be locked in this range. And as I talked about the other day, it's kind of changed the range. It used to be 1840 to the 1890 level. Now we're really looking at we'll call it 1820 to the 1870 level. So it's changed a little bit. It's stair step down, but it's not so generating any type that's situation that's very, very negative. So once again, I want to thank you for participating in these broadcasts. We're actually starting to get a lot more traction. I'm impressed with what we've been able to do in a short period of time. We're opening up some of our meetings next week, probably toward the end of the week, about, we're going to call it Process Warriors. I've preached about process over attitude and opinion. Well, we're going to go through all the processes that it takes to run this software successfully in your practice, and really go through a lot of detail, understanding the software, understanding building, maintaining all the different elements, and then a lot of in-between stuff. Anyway, folks, have a great weekend. Have a safe holiday weekend, and we'll talk to you next week.